You just signed the papers. $40 million wired in one keystroke, and just like that, you own it. A 5-star hotel. Marble lobby, infinity pool curling toward the ocean, a fleet of staff in crisp linen uniforms waiting for your first nod of approval. Someone hands you a glass of champagne. Somebody else hands you a key card with your name engraved on it. For about 11 seconds, you feel like the richest person alive. Then the accountant walks in. Not with congratulations, with a spreadsheet. Your first monthly P&L statement, and before a single guest has checked into a single room, before $1 of revenue has technically been earned, you're already down 6 figures. Payroll for 240 staff members. Property insurance on a beachfront asset in a hurricane zone. Franchise fees to the brand whose name is bolted to your building. Utility bills for a property with more square footage than a shopping mall. You bought a hotel. What you actually bought was a business that costs more to keep the lights on than most people's annual salary, and it hasn't sold a single room yet. This is the moment nobody shows you in the fantasy. Not the ribbon cutting, not the champagne. This one, the spreadsheet moment where you realize that owning a 5-star hotel and running a profitable one are two completely different games. So what actually separates the owners who make it from the ones who quietly go broke behind the marble? It starts with a number almost nobody checks before they buy. Here's the story we tell ourselves about luxury hotels. Expensive rooms equal expensive profits. Charge $900 a night, fill up 150 rooms, and the math practically does itself. It feels obvious. It feels almost lazy not to be rich doing this. That's the fantasy. Here's the ledger. A budget motel off the highway and a 5-star resort on the coast are not the same business wearing different clothes. They're fundamentally different animals. The motel needs a night clerk, a housekeeper, and a vending machine. The 5-star property needs a full culinary brigade, a concierge desk, a spa staff, a security team, a landscaping crew maintaining grounds the size of a small park, and a general manager whose salary alone could buy a modest house. Every dollar of that $900 room rate is already fighting off a small army of costs before it becomes profit. This is the myth we need to bust right now. Luxury hotels don't print money because the rooms are expensive. They survive, or don't, because of how efficiently they convert that expensive rate into rooms that are actually consistently occupied. A luxury hotel with sky-high prices and half-empty hallways isn't a status symbol. It's a business hemorrhaging cash in a 5-star wrapper, and this is where most first-time hotel buyers get seduced. They fall in love with the ADR, the average daily rate, because it's the number that looks impressive on a brochure. $900 a night sounds like wealth. But ADR alone tells you almost nothing about whether this business survives the year. There's another number, a quieter one. One that hotel operators watch obsessively and outsiders almost never think to ask about, because it doesn't show up in the glossy photos, and it definitely doesn't show up in the sales pitch. Before we get there, though, let's talk about where all that revenue is actually going, because the cost side of this business is where the fantasy really starts to crack. Picture a guest checking into your hotel tonight. She's paying $900 for the room. In her mind, that's pure luxury, a fair trade for thread count sheets and an ocean view. What she doesn't see is the invisible line of people already standing between her and your profit. Hands out before you ever touch that money. Start with labor. Because in a 5-star property, labor is brutal. Budget hotels run on a staff-to-room ratio you could count on 2 hands. Luxury properties often need 1 staff member for every room, sometimes more. Housekeeping, valet, front desk, room service, spa therapists, a chef's brigade cooking 3 services a day whether the restaurant is full or empty. Payroll doesn't pause because occupancy dipped this week. It's relentless, and in hospitality, it's usually the single largest expense on the books. Then come the fees nobody puts on the postcard. If your hotel carries a recognizable luxury brand, the kind of name that makes guests trust the property sight unseen, you're paying for that trust. Franchise and management fees typically run 3 to 5% of total revenue, plus mandatory contributions to a shared marketing fund. That's before a single light bulb is changed. Speaking of which, utilities on a property this size are staggering. Climate control across hundreds of rooms, heated pools, landscaped grounds, drinking water in a hot climate, kitchens running industrial equipment around the clock. Add property insurance, often elevated because luxury properties tend to sit in exactly the coastal or high-value locations most exposed to natural disaster risk. Add property taxes, assessed against an asset now worth tens of millions. Add a reserve for replacement fund, because 5-star guests notice worn carpet and outdated fixtures, so smart owners are required to set aside capital every single year just to keep the property looking the part. So let's go back to that guest and her $900 room. By the time you account for labor, brand fees, Utilities, insurance, taxes, and reserves, somewhere around $300 of that payment was already spoken for. Gone before you calculate a cent of profit. She has no idea. She just thinks she bought a nice room for the night. This is the part most aspiring owners never model out. They see the top line number, the rate, the revenue potential, and never build the cost stack underneath it. But costs like these are fairly predictable. They don't swing wildly month to month. Revenue, on the other hand, swings constantly. And that brings us to the number that actually determines whether this business survives. Here's the number hotel operators actually live and die by, and it's shockingly simple. RevPAR, revenue per available room. You get it by multiplying occupancy rate by average daily rate. That's it. 2 inputs, 1 number, and it tells you more about a hotel's health than any brochure ever could. Let's make it real with 2 hotels, both proudly waving the same 5-star flag. Hotel A is the one that photographs beautifully. $900 a night, dripping in exclusivity, deliberately scarce. But exclusivity has a cost. It only fills 50% of its rooms on an average night. Multiply it out, 900 times in 50 gives you a RevPAR of $450 per available room. Hotel B looks less flashy on paper. $600 a night, respectable, but not headline grabbing. Except Hotel B has figured out something Hotel A hasn't. How to actually fill rooms. It runs at 80% occupancy night after night. Multiply it out, $600 times 0. 80 gives you a RevPAR of $480 per available room. Ride that again. The cheaper hotel, the one that looks less impressive, less exclusive, less like a status symbol, is generating more revenue per room than the one charging 50% more per night. Scale that across a 200-room property 365 nights a year, and Hotel B is pulling in millions more in annual revenue than Hotel A, purely because it solved the occupancy problem instead of chasing the prestige problem. This is the trap that swallows so many first-time luxury hotel buyers. They fall in love with ADR because it feels like the badge of a serious high-end property. But ADR without occupancy is a beautiful number attached to an empty building. It's the hospitality equivalent of a stock trading at a sky-high price, with nobody actually buying shares. The lesson isn't that cheaper is always better. It's that the 2 numbers only mean something together. A hotel chasing rate at the expense of occupancy can look successful in a pitch deck and still be quietly starving. And RevPAR, as important as it is, still isn't the number that decides whether you keep the business or lose it. It tells you how much revenue you're generating. It says nothing about how much revenue you actually need. Just to survive the month, that number is next. And it's the one almost no first-time buyer calculates before they sign. Here it is. The number that separates hotel owners from hotel casualties, and almost nobody asks about it before they buy. Break-even occupancy. It's a simple question with a terrifying answer. Given your fixed costs, payroll, franchise fees, insurance, taxes, debt service, all of it, what percentage of your rooms do you need to fill every single night, on average, just to cover your bills? Not to profit, just to survive. Let's build it with round numbers you can follow in your head. Say your 5-star property has $12 million a year in fixed costs. The expenses that don't shrink just because fewer guests show up. Your average daily rate is $600. And let's say variable costs eat about 40% of each room sold, leaving $360 in contribution per occupied room. Divide that $12 million by $360, and you need roughly 33,000 room nights sold a year just to break even. On a 200-room hotel with 365 nights available, that's about 45% of your total inventory. 45% doesn't sound so bad, until you learn where luxury hotels actually operate. Global average occupancy for 5-star properties tends to hover in the 60 to 65% range in a healthy year. That means many owners aren't operating with a comfortable cushion above break-even. They're operating dangerously close to the edge of it, riding a 15 to 20-point margin between profitable and underwater. Now imagine a bad quarter, a regional downturn, a new competitor opening 2 blocks away, a shift in travel patterns nobody predicted. Occupancy doesn't need to collapse to 0 to sink you. It just needs to slide from 62% to 48%, and suddenly you're not running a 5-star hotel anymore. You're running a very expensive, very beautiful liability, bleeding cash every single month, with marble floors that don't care whether you can make payroll. This is the number that determines whether you own an asset or a hostage situation. And here's the uncomfortable truth. Most first-time hotel buyers never calculate it. They calculate potential revenue. They calculate ADR. They fall in love with photographs of infinity pools. They almost never sit down and ask, how far can occupancy fall before I'm underwater? And how often does that actually happen in this market? Because here's the thing about break-even occupancy, it assumes your fixed costs stay fixed. But there's one cost that doesn't just stay fixed when revenue drops. It actively punishes you for it. And that's where leverage comes in. Almost nobody buys a 5-star hotel with cash. That $40 million property from our opening scene, in the real world, a huge chunk of that purchase price is borrowed, often 60, 70, even 80% financed through debt. And debt is a strange partner in this business because it doesn't care what your occupancy rate is doing. It doesn't care that room revenue is seasonal, unpredictable, and vulnerable to shocks nobody saw coming. The bank wants its payment on the first of the month, every month. Full stop. This is where break-even occupancy stops being a spreadsheet exercise and starts becoming a survival mechanism. Let's run the scenario every hotel owner fears. Say your property is humming along at 62% occupancy, comfortably above break-even, generating real profit, everything looking healthy. Then something happens. A recession, a pandemic, a wildfire season that guts tourism in your region for a summer. Occupancy drops just 10 percentage points down to 52%. 10 points doesn't sound catastrophic. But remember, your fixed cost didn't drop 10%. Your debt service didn't drop at all. Your payroll, your insurance, your franchise fees, all still due in full, on schedule. That 10-point occupancy drop doesn't just shrink your profit margin. In a highly leveraged property, it can wipe out your entire profit and turn your monthly debt payment into a cash outflow you're now funding out of pocket or out of a dwindling reserve account. This isn't a hypothetical. It's exactly what happened to hotel owners across the world in 2020. Not because their properties were badly run or their brands weren't strong or their staff wasn't excellent, but because the math of fixed debt collided head-on with collapsed variable revenue, and there was no bridge between the two. Occupancy fell off a cliff almost overnight, and highly leveraged owners found themselves personally guaranteeing loans against an asset that was actively losing money every single day it stayed open. This is the double edge. Leverage is what makes hotel ownership possible for most buyers. Nobody's writing a $40 million check in cash. But leverage is also what turns a temporary occupancy dip into an existential threat. It amplifies the upside when times are good, and it amplifies the downside with equal merciless efficiency when times turn bad. So here's the real question hiding underneath all of this. If the risk is this real, and the margins are this thin, is owning the physical hotel even the smartest way to get exposure to this industry? Or is there a version of this bet that gives you the upside without strapping a multi-million-dollar mortgage to your name? Let's find out by putting two completely different investors with the exact same amount of capital, head-to-head, meet two investors. Same net worth, same amount of investable capital, $20 million each, same starting year. From here, their paths couldn't look more different. Investor 1 buys the dream. She puts her $20 million in as equity, borrows the rest, and becomes the proud owner of a boutique 5-star hotel. She's now responsible for payroll, brand renewals, insurance renegotiations, and a general manager who calls her every time something breaks. Because in hospitality, something is always breaking. Her upside is real. In a strong year, hotels can generate returns that make index funds look sleepy, especially once you factor in leverage amplifying her equity returns on a well-run property. But her downside is just as real, and we already walked through exactly how ugly that gets when occupancy dips and debt service doesn't. Investor 2 takes the boring road. He puts his $20 million into a diversified index fund. Or, if he wants hospitality exposure without the operational nightmare, a basket of publicly traded hotel REITs. He does nothing else. No staff meetings. No 2 a.m. calls about a burst pipe in the East Wing. No franchise renewal negotiations. He checks his statement a few times a year and otherwise goes back to his life. Now fast forward 10 years and compare what actually happened. Investor 1's returns are lumpy and unpredictable. Spectacular in boom years, terrifying in downturns, and dependent on her ability to manage a genuinely difficult operating business well. Her capital is almost entirely illiquid. If she needs cash in a hurry, she can't sell half a hotel. Her risk is concentrated in one asset, one location, one brand relationship, one local economy. Investor 2's returns are smoother. Historically, diversified index funds have delivered solid long-term annualized returns with far lower volatility, and hotel REITs specifically give him hospitality sector upside, like RevPAR growth across an entire portfolio of properties, without ever touching a mop or negotiating with a union. His capital stays liquid. He can sell shares on a Tuesday afternoon if he needs to. His risk is spread across dozens or hundreds of properties instead of riding or dying with one. Here's the uncomfortable truth this comparison reveals. Investor 1 isn't necessarily wrong. If she has genuine hospitality expertise, favorable debt terms, and the operational chops to run a property well, she can absolutely outperform. But for most people chasing the fantasy, people drawn to the marble lobby, not the balance sheet. Investor 2's boring, diversified, liquid position quietly wins on a risk-adjusted basis, almost every time. The dream sells the lobby. The math sells the spreadsheet. And spreadsheets, it turns out, don't lie nearly as often as brochures do. Even if you've done everything right, you've calculated your break-even occupancy, you've stress-tested your leverage, you've built a realistic RevPAR model, there's a second wave of risk waiting for you, and it rarely shows up in year one projections. Meet the PIP, the Property Improvement Plan. Every major hotel brand requires one, typically every 7 to 10 years, and it's not optional. The brand shows up with a checklist. Renovate the lobby, replace every mattress, overhaul the spa, modernize the rooms, and you pay for it, whether or not you budgeted for it. These renovations routinely cost 15 to 20% of the entire asset's value. Imagine owning that $40 million hotel, finally hitting your stride financially, and then getting handed a $6 to $8 million bill just to keep your brand affiliation. Speaking of that brand affiliation, it's not permanent. Franchise agreements come up for renewal, and brands can walk away, renegotiate on worse terms, or demand upgrades as a condition of staying. Lose your 5-star flag, and you don't just lose prestige, you lose the reservation system, the loyalty program traffic, and a huge chunk of the guests who booked specifically because they trusted that name. Then there's reputational fragility. A 5-star hotel's entire value proposition rests on perception. One viral bad review cycle, one scandal involving a high-profile guest, one health code violation photographed and shared 1 million times. An occupancy can crater in weeks, long before your next earnings statement even reflects it. And finally, the black swans. Pandemics, natural disasters, currency crises that gut international travel to your region, geopolitical instability near a market you depend on. These aren't hypothetical footnotes. They're recurring, historically documented events that hospitality has weathered again and again, each time catching leveraged owners off guard. None of this means hotel ownership is irrational. It means it's a business with risk layers. Most buyers never model the ones underneath the obvious ones. So if the marble lobby was never the whole story, what actually separates the owners who thrive from the ones who quietly lose everything? That's where we land next.